Welcome student. Let's start with the chapter 1, Introduction to the Foreign Exchange Market. Introduction. The foreign exchange is the trading of one currency for other. It is the largest financial market in the world with an estimated 5 trillion in dollars value traded daily. Forex provide incomes to millions of traders and large banks worldwide. And now we will learn about the history of Forex market. 1876 Gold Exchange Standard. In 1876, something called the Gold Exchange Standard was implemented. Basically, it said that all paper currency had to be backed by solid gold. The idea here was to stabilize world currencies by pegging them to the price of gold. It was a good idea in theory, but in reality, it created boom-bust patterns which ultimately led to demise of the gold standard. World War II gold standard was dropped. The gold standard was dropped around the beginning of the World War II as major European countries did not have enough gold to support all the currency they were printing to pay for large military projects. Although the gold standard was ultimately dropped, but the precious metal never lost its spot as the ultimate form of monetary value. 1944 Beginning of Bretton Woods System. In 1944, the world then decided to have fixed exchange rate that resulted in US dollar being the primary reserve currency and that it would be the only currency backed by gold. This is known as Bretton Woods system. 1971 End of Bretton Woods system, Nixon shock and birth of Forex market. By late 1960s, the fixed exchange rate system started to break down due to a number of international policies and economic factors. Finally, in 1971, President Nixon stopped the US dollar being converted to gold directly as a part of a set of measures designed to stem the collapse of US economy. This was known as Nixon shock and led to floating rate market being established in early 1973. In 1971, US declared that it would no longer exchange gold for US dollar that was held in foreign reserves. This marked as the end of Bretton Woods system. In the same year, foreign exchange market was established and floating exchange rates were introduced. As the world continued to tear itself apart in Second World War, there was an urgent need for financial stability. International negotiators from 29 countries met in Bretton Woods and agreed to the new economic system where exchange rates would be fixed. This was effectively the birth of current foreign exchange market. With floating rates, currencies could be traded freely and the prices based upon market forces. Forex market was born. Mid 1990s, beginning of electronic trade system. Although the forex market had started in 1973, though it did not become widely electronically traded until the mid of 1990s. Now we will learn what is forex. Forex is an art of making money in which currencies are traded. The forex market is also referred as FX market, currency market, or foreign exchange market. The forex market is the most liquid market in the world with an average volume of $4 trillion per day. The amount of money traded in a week is bigger than the entire annual GDP of United States. The forex market is open 24 hours a day for 5 days a week and currencies are traded worldwide among the major financial centers of London, New York, Tokyo, Frankfurt, Hong Kong, Singapore, Paris, and Sydney. Forex is an international market for the free trade of currencies. Traders place order to buy one currency with another. For example, a trader may want to buy euro with US dollar and will use forex market for the same. Forex trading, as it relates to the retail traders like you and I, is the speculation on the price of one currency against the another. For example, if you think euro is going to rise against the US dollars, you can buy the euro USD currency pair low and then hopefully sell it at a higher price to make a profit. Of course, if you buy the euro against the dollar and the US dollar strengthens, you will be in a losing position. So, it's important to be aware of the risks involved in the trading forex and not only the reward. And now let's talk about the features of the forex market. Number 1, instant profit. Unlike other share markets, you need not wait for the profits. You can get instant profit if you trade smartly. The next is work globally. Since forex market is a worldwide market, so you can trade from anywhere in the world provided you have a computer or a laptop along with the internet connection. Number 3 is never ending market. Now, number 4, high return with even short investment. If you trade smartly, you can get very high returns even you invest a very small amount. Number 5, the only decentralized market. It is the only decentralized market in the world. That means this market doesn't have any boss. You are the boss of your work. The next point is no special workstation required. As mentioned earlier, that it is a decentralized market in the world and it's worldwide market, so you need not any special workstation. If you have a laptop along with a good internet connection, you can work from anywhere in the world. Point number 6, generate revenue without any inventory or raw material. As you all know that if you want to start any business, you need a raw material in form of anything, like if you are trading in clothes, you need garments or something else. Even you need a manpower. But in this market, you do not need any such thing. It's only a small investment from which you can get a good revenue. One of the best features of Forex market is the demo account. Unless you are expert enough to trade yourself with the real money, you can go along with the demo account. This account has all the features same as the original account but not the money. You can use the same strategy, the same methods as you do in the real account to learn how to trade perfectly. The next feature is no competition. If you remember, we already discussed that this market is a decentralized market, so that means there's no boss, there's no competition at all. You are the boss of your business and you can work as per your need, as per requirement, and as per your flexibility. Next point, 24-hour market. This market is open for the 24 hours a day for 5 days in a week. So you can trade as per your timings, as per shift, as per your flexibility, and you can earn a good money. Point number 10, everlasting market with no change in trend. You might have noticed that market around you keeps on changing in trend after every few years, but this market from the very beginning has no change in the trend and it's going on as same as. The next point is unique for physically handicapped and housewives. As we already discussed that this market is a decentralized market and it doesn't need any special workstation to work on, so it is an ideal market for people who are physically handicapped and even for housewives who cannot go out to the office to work, and such they can work from their home even sitting in their beds. No dependency. Being a decentralized market, there is no boss of the market, so you need not depend upon your employer, nor like other businesses you depend upon your customers for the earnings. So you are not dependent upon anyone. You are the boss of your business and you can work according to yourself. The last but not the least feature of this market. On an average of $300 is traded for each individual per day. Now let's learn who trades and why. All around the world, there are so many bodies who trade. Most of these bodies are government, like banks and central government banks. Besides, the companies, hedge funds, individual investors, and forex retail traders also trade. Number 1. Banks. The interbank market allows for both the majority of commercial forex transactions and large amount of speculators trading each day. Some large banks trade billions of dollars daily. Government or central banks. A country's central bank can play an important role in foreign exchange market. They can cause an increase or decrease in the value of the nation's currency by trying to control money supply, inflation, and or interest rates. Hedge funds. Somewhere around 70 to 90% of all foreign exchange transactions are speculative in nature. This means the person or institution that bought or sold the currency has no plan of actually taking delivery of the currency. Instead, the transaction was executed with the sole intention of speculating on the price movement of that particular currency. Retail speculators like you and me are small cheese compared to the big hedge funds that control and speculate with the billions of dollars of equity each day in the currency market. Individuals. If you have ever traveled to a different country and exchanged your money into a different currency at the airport or bank, you have already participated in foreign currency exchange market. Investors. Investment firms who manage large portfolios for their clients use the forex market to facilitate transactions in foreign securities. For example, an investment manager controlling an international equity portfolio needs to use the forex market to purchase and sell several currency pairs in order to pay for foreign securities they want to purchase. Retail forex traders. Finally, we have come to retail forex traders like you and I. The retail forex trading industry is growing every day with the advent of forex trading platform and their user accessibility on the internet. Retail forex traders access the market indirectly either through a broker or a bank. There are two main types of forex retail brokers that provide us with the ability to speculate on the currency market. Brokers and dealers. Brokers are the agents for the trader by trying to find the best price in the market and executing on behalf of the customer. For this, they charge a commission on the top of the price obtained in the market. Here is a table that shows the market size and liquidity starting from 1989 to 2010. From the table you can see that in 1998 there was a huge difference of liquidity with the past year 1995. And once again in 2007 there was a big difference with the past survey in 2004. What was the reason? Now, the reason was firstly, emergence of retail investors, secondly, the evolution of internet. As the retail investors invested their money because of the internet, now the liquidity had increased a lot. Currency pairs. The currency pairs are always important when you trade because whenever we trade, we use one currency against the another. Basically, there are two types of currency pairs. Firstly, major currency pairs. These currency pairs involve US dollars and also known as reserve currency pairs. Below are given some of the major currency pairs which involve US dollars. Second comes cross currency pairs. These currency pairs do not involve US dollars. Below are few cross currency pairs given. The below given chart shows the market size and liquidity. How big is the forex market in terms of average trading volume? From the table, it's clear that it is 5 times bigger than the New York Stock Exchange, which is the world's biggest stock exchange. That brings to the end of the chapter 1. Thanks for your participation.